Hi guys, it's me again, making another Zoom video, this time on the highlight of week 4, which would be closing entries. So it's going to be another shorty, again, kind of straight to the point, to help you guys out with the material for the week. So the big thing with closing entries are what is their purpose? Closing entries are meant to close out or to refresh, to send to zero, any of those, to close out certain types of accounts at the end of the year. The reason is some accounts start from zero each year, and the company builds them every year, gets a total figure at the end of the year, and then zeroes them out. The accounts that are affected by closing entries are owner's drawings, all revenue accounts, and all expense accounts. All right. The reason is predominantly when you're looking at the revenues and the expenses, anything that leads to income gets closed out. Income for a company is only shown as a yearly total. So if you say 2018, that means income for 2018 is only shown from January 1st to December 31st. One big snapshot. Then on January 31st, on December 31st, once the books are made, once the financial statements are prepared, they close out the income accounts, so revenue and expenses, and they start fresh. So in 2019, now they're starting at zero and building up their income and building up their expenses again. All right. This is why it's important, because investors only care about your income for a certain year. And sure, they're going to compare your income over years, but they only want to see how much income did you earn in 2018, how much income did you earn in 2017. They don't want to see a figure at the end of 2018 that includes a loss from 2017, a gain from 2016, more losses from 2015 and 14, more gains from 2013. It's not as relevant. So what they do is they close out all the income accounts at the end of every year and start fresh. They also do this with owner's drawings. Okay, so whenever the owner withdraws money, it builds back up. Any balance sheet account, so if you could find it on the balance sheet, it does not close. So all your assets, your liabilities, and then owner's capital, all of these do not get closed out. So when you're doing your weekly assignment, I don't want to see any journal entries that affect any of these accounts. Okay? I do want to see journal entries that affect owner's drawings if it's part of the assignment, any revenue. So if you had rent revenue here, if you had interest revenue, all revenue gone, and then all expenses. So when it comes to the journal entries, the first thing you want to do, it's generally broken up into 4 parts. First, what you do is you get rid of the revenues. When you're looking here on the trial balance, and this would be an adjusted trial balance. I'll add that up here. Oh, adjusted. Okay. So this happens after you make the financial statements. So everything's prepared. You look here. You have 2 revenue accounts. Revenue is the first to get closed. If revenue accounts have a credit balance, which they always will, how would you get rid of something with a credit balance? You're going to debit it. So we're going to debit fees earned for $70,000, and we're going to debit sales revenue. Again, fees earned, depending on what you've seen it as, it's service revenue. Again, there's no set format in what some of these accounts should be called. Debit, debit. Now we have 2 debits. Rules of journal entry say debits have to equal credits. We don't have a credit yet. The closing process we're going to do involves crediting this account called income summary for whatever you need to credit it for. So in this case, the debits total $130,000. So we're going to credit income summary $130,000. Okay? With me? Income summary is what's called a temporary account. It is used only for closing entries. It will never have another purpose but in this closing entry process. We're going to create it today, and then we're going to eliminate it today. What I am going to do, though, is I'm going to build a T account for it so we can keep track of its balance. So income summary. So we just credited the account $130,000. Next step in the closing process, close out the expenses. Okay. Expenses have a debit balance. If you want to get rid of something with a debit balance, you have to credit it. I'm going to jump ahead. We're going to credit all those expenses. We're going to have to debit some account. Guess what? The account we're going to debit is income summary. I don't know the amount yet, so we're going to go ahead and we're going to credit all the expenses. So we're going to credit salaries expense for $10,000. We're going to credit depreciation. I'm going to abbreviate depreciation expense, $5,000. We're going to credit utilities. Again, you would put the word expense there. I'm kind of just moving through it. $4,800. And we're going to credit rent expense. $4,200. All right. Income summary is going to be used again just for its sole purpose in life to offset these credits. So when we total these up, they equal $24,000. So we're going to debit income summary $24,000. All right, we're going to update the T chart here. So income summary now, we credited it $130,000. We debited it $24,000. Its balance is going to be a credit for the difference. The third step in the closing entry process is to close out income summary. So income summary, this won't always be true. Sometimes the expenses are greater than the revenues. If that was the case, if this number was bigger than this number, it would have a debit balance. So you close out income summary based on whatever you need to do to the account. In this case, it has a credit balance, so we will need to debit it. So we're going to debit income summary for that balance, $106,000. Whatever we need to do to bring it down to zero. All right, so if we did this, once we debit it, its balance would be zero. Money. What we offset income summary to, now that all things are said and done, is actually going to be owner's capital for whatever the amount was that we hit income summary. So this, when we first credited income summary, we credited for the revenues, we debited for the expenses. This figure, if it's a credit value, this is the company's net income, revenues minus expenses. If it was a debit amount, the expenses were bigger than the credits, it'd be a net loss. So what we just did, we had a net income of $106,000. We just transfer that to owner's capital. So net income becomes part of owner's capital at the end of the year. So does net loss if it exists. So once that's transferred, income summary is done. The last step, close out drawings to capital. So if drawings have a debit balance, we're going to have to credit drawings. Like my little description says, we debit them against owner's capital. 2,000. So to get rid of owner's drawings, again, they have a $2,000 debit balance. We have to credit them. Credit owner's. And now all of the necessary accounts are closed out. And you could go ahead, you post these in the ledger. So you have to post them. The only accounts that should have anything posted in their ledger are any of the accounts you made journal entries for. So when you're doing your assignment, it's going to try to trick you. It's going to show you a whole bunch of accounts in the ledger, equipment, supplies, cash. You don't have to actually post anything in those because you are not touching them with your journal entry. Once you post in the ledger, you make what's called a post-closing trial balance. And all that balance should be is it should show all these figures, your revenue, expense, and drawings at 0, and it should show owner's capital at the updated amount. None of these should change. Assets or liabilities should not change because nothing changed here. All right, again, somewhat short, sweet. Ask me questions, though, if you need more. Bye.